Most people think investing is about finding the right stock. The intelligent investor makes a far more unsettling claim. The greatest risk is not the market, but the person looking back at you in the mirror. First published in 1949 by Benjamin Graham, often called the father of value investing. The Intelligent Investor was written in the aftermath of the Great Depression and before the rise of modern speculative finance. Graham had lived through market manias, crashes, and recoveries, and his conclusions were not optimistic in the emotional sense. They were disciplined, restrained, and deeply psychological. This book is not about getting rich quickly. It is about not destroying yourself slowly. At the center of Graham's thinking is a distinction that immediately creates tension: the difference between an investor and a speculator. The investor, Graham argues, is not defined by what they buy, but by how and why they buy it. An investment is something that, after thorough analysis, promises safety of principal and an adequate return. Anything that does not meet those criteria is speculation, regardless of how popular it may be. This reframing forces an uncomfortable realization. Most people in the market are not investors at all. They are reacting to price movements, narratives, and emotions while convincing themselves they are being rational. Graham exposes how easily intelligence can become a liability when it is paired with overconfidence. One of the book's most enduring ideas is the concept of Mr. Market, an imaginary business partner who shows up every day offering to buy or sell shares at wildly different prices depending on his mood. Sometimes he is euphoric. Sometimes he is depressed. Graham's insight is that Mr. Market exists to serve you, not guide you. His prices are information, not instructions. The psychological conflict here is central. When prices rise, confidence feels justified. When prices fall, fear feels rational. Graham insists that intelligent investing requires emotional independence. You must learn to distrust your own impulses precisely when they feel most convincing. Another core principle of the intelligent investor is the margin of safety. Graham argues that the future is inherently uncertain, and because of this, intelligent investors must build protection into their decisions. Paying less than something is worth is not pessimism. It is humility. The margin of safety is what allows survival when forecasts fail, and they always do. Importantly, Graham does not promise superior returns through brilliance. He promises acceptable returns through discipline. This runs counter to modern financial culture, which glorifies complexity, speed, and constant action. Graham views excessive trading as a symptom of emotional instability, not skill. The book also challenges the belief that effort guarantees success. Graham repeatedly emphasizes that markets do not reward activity, they reward patience. The investor's advantage lies not in superior information, but in superior temperament. What makes the intelligent investor timeless is that it treats investing as a moral and psychological practice. It demands self-control, skepticism, and a willingness to appear boring. It warns that the desire to outperform others often leads to underperforming yourself. In the end, Graham leaves the reader with a quiet but devastating conclusion. The investor's chief problem and even his worst enemy is likely to be himself. Markets will fluctuate, prices will mislead, opinions will shift, but character, once formed, determines outcomes over decades. If this perspective reshaped how you think about risk, return, and self-discipline, support the channel by liking the video, subscribing for future deep dives, and continuing with the next book in the series.